That's an unwanted annuity. That's what we're going to talk about here today at the Heritage Wealth Planning YouTube channel. As you can see up on my tab list, I got tons of different tabs open. Now I got to get some of these removed to make my system go faster. So we're going to talk about this article I've been sitting here over almost a week now that I want to dive into real quick. It's not a huge article, not too lengthy, but it's pretty important, especially if you are one of these people who have an unwanted annuity. How do you know if you should keep it or not? So let's dive right into this. Don't forget to subscribe down below. And, of course, comments, thumbs up, the whole thing help me immensely. And then just go to blog at heritagewealthplanning.com. And so let's dive right into this. And as always, every now and again, again, that's Christmas season. If you like the channel and you want to support it, the best way to do it is I got a link down there. Just click on my Amazon thing. That way, if you buy something on Amazon, regardless if it's a new calculator, regardless of some reading glasses, if you click on through my link and you make a purchase via Amazon, it pays me. I think it's like a 4% commission. So if you spend $100, I get paid $4, which I would appreciate. So, not trying to beg you, but if you're going to do it and you like the channel, that's a way to support me. So, all right, let's dive right into this here. It's a pretty interesting article from Advisor Perspectives. And if you know the YouTube channel that I do here, you know I love Advisor Perspectives. AdvisorPerspectives.com. A guy named Jeff Rancourt. I've heard of this guy before. I can't remember why. Anyway, but he wrote this on 11/26, how to assess an unwanted annuity. And he's an insurance consultant to RIAs, registered investment advisors, which I am one. He reviews legacy annuities, but every case is unique. But I'm often reminded why commission-based annuities are one of the biggest violators of consumer value within the financial services industry. I, for the most part, agree with that. Rider-driven variable annuities are the most common review requests that I receive. They tend to be the most complex and expensive. Often, the policy owner doesn't even understand the product they have or why they even own it. Let's see. And then he talks about what an advisor should do. Okay, so let's start with a suitability check. So this is for you as a client, your own client. You're looking at it for yourself, not through an advisor. But let's just say, 10 years ago, you bought a variable annuity. You're not really sure why you have it. The guy who sold to you is now selling cars. And you're like, do I need this anymore? So no one knows your own financial situation. Consider how and if the annuity will continue to help you. For example, this is huge. All right. Well, I want just keep listening. Many variable annuities are purchased to achieve growth and provide guaranteed income. Now, if you watch my series, my 6-part series on the Vanguard study, Vanguard run a couple different numbers on Vanguard to provide guaranteed or provide income in retirement. I showed you that you can't get both. If you're getting one, you're going to sacrifice the other. There's no other way around that. It's important to determine whether growth and especially income will be needed or wanted from the policy. The client may have already have those needs met elsewhere. I often see a client paying high fees for a contract with features they didn't plan to use. If growth is an objective for your client, examine the level of insurance the annuity offers for protection against losses within the rider. This is important since logic dictates that allocations should shift into conservative funds to protect against sequence of return risk as the client ages. If the annuity is designed to insure against market losses, there's arguably no need to be conservative since the risk has shifted to the insurer, albeit at a higher cost. And I'm just telling you, so this is critically important. I cannot begin to stress how many people have variable annuities in the conservative to moderately conservative portfolios. I'm like, oh my goodness, why are we doing this? The point is, like Jeff says, the insurer, the risk has been sent to the insurance company, and you're paying a fee for them to assume that risk, which means you might as well be swinging for the fences because you are guaranteed either an income stream or against market losses. One of those two things, depending on how your contract is written up. So if you have these guarantees, why would you not swing for the fences as aggressively as you can in your variable annuity? Do not be moderately conservative to conservative investor inside a variable annuity. We'll talk about the cost here in just a second when you're paying for these guarantees. In fact, excuse me, if you look at it, a lot of variable annuities don't even allow you to get more than like 70% stocks because they know they're assuming the risk and they don't want the risk either. So if you have a variable annuity and you can't sell it to get out of it for whatever reason, I just do not have it in a conservative portfolio. It literally doesn't make any sense. You're paying for safety for an insurance company when you already have safety in the portfolio holdings that you have. In terms of guaranteed income, advisors often don't liquidate policies because they're afraid of giving up guaranteed values. Does your client want or even need to take withdrawals? How much are they paying for the withdrawals they'll receive? It's important to run the numbers as well as the objectives. This way, thoughtful consideration is given to replacing an annuity with a more suitable product or liquidating outright. Okay, so exactly, I could not agree more. Or simply leverage. Okay, skim the statements. When reviewing annuity, I start with the basics. Policy statements may help you uncover certain things. Look at the policy issue date. Now, this is huge right here, my friends. Older vintage policies with guarantees may hold considerable consumer value today, especially if the policy was issued before the financial crisis of 2008. Policies issued after 2009 were mostly repriced as insurance companies saw worst case scenarios test their guarantees. Just going back to what I just said. After 2008, insurance company says, oh man, we took on way too much risk than we were pricing for in terms of the portfolios that their consumers had. So we're going to make sure that doesn't happen again. So if we're going to guarantee these risks, we're going to make sure that the consumers, the clients, don't have more than 60 or 70% stocks, because we can't have a 50 to 60% decline because we're assuming the risk. I'm telling you right now, it's crazy. All right, so this means potential cost advantage or higher guarantees may exist in annuities issued prior to 2009. I cannot stress that enough. I see this all the time. If you have an older annuity policy, you are getting some pretty good bang for your bucks on some of the insurance what's called a rider, like Rider University, RIDER. So if you have an older policy, you are getting pretty good bang for your buck relative to newer policies. That doesn't mean you're getting good bang for your buck relative to not having the insurance to begin with. It doesn't mean that. It just means relative to newer policies, the older policies are much, much more favorable from a financial perspective to you as a client. But that, again, I just got to reiterate, if you don't need the annuity, it's very, very expensive. Check values. Review the statement for values such as surrender amount, cash value, and death benefit amount. I'm just telling. Discrepancies between cash and surrender value will reveal if there's a penalty for moving or closing an annuity. Before, I've talked about variable annuities, the difference between the cash value and death benefit. The cash value, all right, that is not necessarily your walk away amount. All right, the walk away amount is the surrender value. So if it says you put $200,000 in there and your annuity is worth $230,000, that does not mean that is the money you walk away with. I'm just telling you. Part two of this, if you put $200,000 in there and you were under the impression that's going to grow at 7% each and every year, guaranteed, that's called your income benefit base. That is not walk away money. Walk away money simply says, Mr. and Mrs. Annuity Company, I want to check. How much is the check going to be for? That's walk away money. So if you start with $200,000 in there and it's been 10 years and the account's only worth $240,000 and you think it's supposed to be worth $400,000 because you got 7% guaranteed each and every year, that 7% is not part of your walk away money. That's part of your income base. And there might be value there, but I'm just telling you right now, you got to understand how that works. And I would say 80% of annuity owners have no clue. They think they're getting 7% a year year-over-year rate of return. They're not. I said, what's your walkaway balance? And they don't know what that means. So I'm telling you right now, your walkaway balance, you call your insurance company, you say, if I were to cash this out, how much would I be? How much would I get? Well, they'll say you put $200,000 in, you get $235,000 today. That's my walkaway. That's the check you will cut to me. Yes, that's your walkaway balance. That's all that matters. Check for enhanced rider values. Included on the statement will be the death benefit amount of the policy, which will be paid to a beneficiary. Now, death benefit or annuity is not like life insurance. It's not tax-free. It does have IRD, income with respect to decedent, IRD. And that's just like IRA, someone's paying the income tax on the deferred asset growth. IRD, income with respect to decedent. So you're leaving money that has yet to be taxed to an heir. They are going to pay it, be an IRA or an annuity. Sometimes enhanced riders will lock in initial premiums or high value anniversary amounts, review the death benefit values against a cash value. It may uncover additional insurance within the policy to provide legacy asset to heirs. Additionally, many variable annuities are sold with a promise of income, which the owner can't outlive. They offer riders that provide for income with withdrawals for life. On a statement, look for values associated with guaranteed benefit amounts, or like I just said, your income benefit base. While these values cannot be accessed for immediate withdrawal, your walkaway money, they are used to determine how much income can be drawn from the policy over your client's life. A quick way to gauge consumer value when looking at these riders is if the stated income base is higher than the cash value. So again, you start with $200,000, the cash value is worth $240,000, but your income base is $400,000. That's pretty significant. You start with $200,000, your cash value is $240,000, but your death benefit is $200,000. All right, so there's no benefit there to you whatsoever. $240,000 is your walkaway money, your cash value, if that is your walkaway money, and your death benefit is $200,000. Nah, that's a bad option for you right there. We can see kind of, okay. The goal is to identify the amount of lifetime income that can be drawn. Sometimes the figure is included on the statement. Sometimes it's not. So before changing anything with the contract, just make sure you do your research. Gotcha. Variable annuities are often sold to clients without the discussion of fees associated with the product. Knowing the numbers behind annuities is important because your client may not realize how much they pay. Typical annuity cost. Many annuities carry multiple fees within a contract. For starters, variable annuities will sign in M&E expense, mortality and expense fee, M&E. This fee ranges in size, but is common within commission variable annuities to be 1.35% of the total fund value. So you got $200,000 in that. It's going to be 1.3. Take your trusty calculator, $200,000 times 1.35%. That right there alone is costing you $2,700. So remember, we said you have a $200,000 you dropped in the account is worth $240,000 now, and your death benefit is $200,000. That M&E charge, mortality expense, is the $2,700 you're paying for a death benefit that is worthless because your cash value is worth more than the death benefit. If you got hit by a bus today, your heirs aren't getting the death benefit; they're getting your cash value, but you're paying $2,700 a year just in this today, and that will change depending on the account value. It's insane. Then fund expenses add to the overall cost as well. A 1% figure for the fund expense is typical. So between those two alone, you got 2.35. Lastly, enhanced riders can add considerably to the cost. Some of the most popular riders cost over 1% to maintain. So now you're looking at 3% fee all in. Consider a 3%, 5% rule. As you add the typical annuity costs, M&E fee, fund costs, and riders fees, annuities can typically cost near 3%, sometimes more. In terms of guaranteed income returns, many provide roughly a 5% guaranteed stream of income, which varies depending on the age of the client and the contractual obligations. So these figures can serve as a compass for examining consumer value. So again, 3% fees for 5% guaranteed income base. I'm just telling you, man. Some older products sold prior to 2009 may offer of upwards of 6% lifetime guarantees for under 3% fees, for example. Yep, and those days are gone. And they just says consult with an expert. All right, so your clients need insurance and the benefits it provides. It's why the variable annuity market is about $2 trillion, which if you take all the registered investment advisory firms out there, not the Vanguards, we're talking RIAs, the smaller firms, the variable annuity market is that same size. That's how huge the variable annuity market is. It's gigantic. So I'm sure there's some of you watching this have variable annuities. So my question is, when's the last time you looked at them? Has it been a while? If it has been, I highly, highly, highly suggest you look at it again. You got to look at your fees. You got to look at your cash value. You got to look at your surrender value. You got to look at the death benefit. You got to look at the income benefit riders that you have. The three main things: walkaway money, a death benefit, income benefit. So just remember that: death benefit, income benefit, walkaway money, or surrender value. If you can find those three things, and then, if I'm telling you, if the death benefit is below your walkaway money and your income rider is right about the same as your guarantee, as your cash value, and you're paying 3 to 3.5%, it's hard. It's going to be hard for you to make a case that's worth it to me. Anyway, so I hope this helps. As always, look at your variable annuity contracts. If you have questions, thoughts, concerns, put them in the comments down below. Don't forget to subscribe. Go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks, guys.